Welcome to the Dividend Talk podcast, episode 152. Four stocks we are buying right now, and is it really never sell shell? Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavor. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJI. How are you, my friend?
I'm doing really well. Saturday morning here for our listeners when we are recording it. I had a good party yesterday night. So I'm doing actually pretty well. And how are you doing?
I'm good. We have a jam-packed weekend this weekend. We're going to try fit in a couple of shows because I'm off on my vacation. I cannot wait. It's been a hectic week in work, trying to, you know how it goes. Whenever you go on vacation, you're trying to close off all those loose ends. It seems like it's never ending, but I'm finding the laptop is now closed for 2 weeks, and I cannot wait. So roll
Really?
roll on the weekend, and we get maybe three episodes recorded. That's going to be fun as well, actually.
Yeah, exactly. And we had a question from Alexander who was asking, like, what are our destinations? So where are you heading towards? So?
I'm going to Turkey this year.
So you're going to benefit from a depreciated lira.
Exactly. Go and get some cheap clothes. I might come back with bright white teeth, and my hair might be full locks like they see. But yeah, no, I'm looking forward to it. I've only been to Turkey once. I was in Kusadasi, but the people were friendly. It was lovely, nice weather. So I'm quite excited, and I have to say my kids are super excited. They have a shopping list of all the jerseys they want to buy. So it'll be a fun time.
Nice one. Turkey is beautiful, I must say.
Where are you heading?
Yeah, first of all, to Dividend Day in Frankfurt next Saturday. Spend the day there, and then I'm making a little Euro trip through Switzerland, Italy, Croatia, and then the way back Slovenia, Hungary, Poland. So I'm really looking forward to it. It will be a car holiday, and yeah, really looking forward to it.
Yeah, it's a good thing about Europe, isn't it? Like Central Europe, not where I'm from, but you can really drive wherever you want to go.
Exactly. Only the toll roads are killing me because sometimes you just spend like 2 hours in a certain country and need to buy 30 euro vignette for that or something like that. So that's the, but I also get it from the countries, right? If you don't only have tourists passing there, then, why not earn some money from it? Because they do consume the highway. It does cost money to maintain them. So yeah, I get it. It's just an expense that I don't like in my holiday because it doesn't really add value.
Yeah. So we have to talk about Shell on this show. We know we spoke about them quite a lot. We bought them pretty much, I would say, while they're at the bottom. But is there ever a time that we're going to sell Shell? I don't know. They released their Capital Markets Day presentation. I don't know. It's hard to see me ever selling these guys. They just seem to knock it out of the park every single time. We've had another dividend increase, and I don't know. Everything looks really positive.
Yeah, it's another 15% dividend hike. And it's funny, right? Because we're dividend growth investors. We're talking here about, was it a 66% dividend cut at the time or something like that? And we're talking about never sell Shell. But if you were a widow at the time, because they called in the Netherlands a typical stock for widows, because of the dividend safety at the time, not having cut it since the Second World War, and then they cut it, you would have many reasons at the time to sell it. Right, and we both didn't, and this is really interesting why we're still saying never sell Shell, why we are dividend growth investors. But it just shows that not every stock in the portfolio is the same, and some things you anticipate on, or some things you see through because you see value. For me, when a dividend is cut, it's the first thing that comes to mind. Should I sell it? Yeah, because usually these deserve to be sold, because usually there's something fundamentally broken. But in this case, it was in 2020. I saw this already coming since 2016. Yeah, so it was just like 4 years. I thought like, oh well, come now, no, they're still paying it, but they have hardly any cash flow to cover it. So they really reset it, and they used the money then to pay down the debt, to actually do a giant reset on their balance sheet as well. And that's why I never sold Shell. And with the kind of management they have, I can't see myself ever selling Shell, because look at now this new guy that came in. What was his name? Swan or something like that. The new CEO. And I read an article that he's kind of like a street fighter. Yeah, after the teacher Ben van Beurden gave him, and I can see that a little bit in him. I saw him on CNBC giving an interview, and he was so focused and so clear and so articulate, and where how he sees things going. Also about they build up, and I think Shell is like an investment company in the end, and they are like us as dividend growth investor, right? Sometimes some junk sneaks into the portfolio. You are really convinced at the time that it's a good buy, but then after 2-3 years, you wonder like, why do I have this piece of junk in my portfolio, right? And that's the same what they've been doing. They've been testing a little bit with wind energy, a little bit with this, but it's not making them so much money. So there are certain things in the portfolio that they will divest again. Yeah, and to really focus. And what I really, really like about this company is that they are really having a clear investment case, which is really about, first of all, make sure that we have energy. And we have seen what it means with the war in Ukraine and Russia, right? When it comes to, for instance, gas supply. But also, they have been really early in having the right energy mix to support the transition. So for me, it looks like they're not naive. Yeah, you can always argue about whether it's a chicken egg story. If they don't transition faster, then will climate goals not be achieved or not? So that's for me hard to answer. But I love that they bought British Gas at that time as an LNG acquisition, because exactly what we're needing right now in this energy transition to move away a bit more from big black dark oil. They're using LNG, and they're now also investing in like low carbon energy and such. So for me, this is really, really interesting to observe how it's actually moving with the world, and maybe even influence to some extent. And then also like the shareholder return, right? So they are looking at a 10% annual free cash flow per share growth. They say per share growth really, really particularly here, because I know that most of this will be funded by buybacks. Yeah, they are now doing a 5 billion buyback again, which is another few percent of less shares outstanding. Yeah, that's paying also for this 15% dividend hike. If you're buying almost 10% back or 8% back on a year, then the real hike is maybe like 5-6% that they are giving, which is in line with their 4% dividend hike that they want to give over time. Yeah, but the buybacks are pushing it up, and that's what's so nice about this investment case here.
Yeah, I mean, what was interesting about this presentation that they gave is that it seems to be pivoting back for a period of time towards the end of the previous CEO's reign. They were more talking about sustainable energy and moving in that direction. There's a lot less talk of that now, and more emphasis on oil and gas, but more so on gas. Gas seems to be the big driver here.
Yeah.
They're talking about these low carbon solutions, and gas is going to play a huge role in that. And when you think about it, gas is, or LNG as they call it, it is easily transported. It's probably one of the most easily transported materials that we will have. So it's quite interesting to see that pivot back. And I think it's obviously the right decision. We do know that you're going to have solar power, wind power, and oil. We're going to have all these solutions, but when will they be a fully sustainable solution, making them money?
Yeah,
that was, I suppose, our concern, and it's nice to see him pivot back to gas. But what I also like is, if you scroll down, they have a couple of paragraphs. One of them, they mention how they're laser focused. That made me chuckle. It's in there, but they're very clear on their responsibility to their shareholders. And when I was reading it, some of it actually made me think very Dutch, very a bit like you were talking to me, really. But what they say is, at the heart of everything that we do, we will be ruthless in our approach to capital allocation and a singular focus on creating long-term value. We will make every dollar count, be unemotional with our spending, and deliver performance, not promises. It was like you wrote that. Honestly, I could see you screaming that at me, but I think it's very clear that they are they are shareholder focused, and they are trying to deliver. We know they had that dividend cut. At the time, it looked like it was the right decision, but since then, they are increasing their dividend at a phenomenal rate. They are reducing their debt at a phenomenal rate. They are reducing their capex at about 2 to 3 billion a year. Everything they seem to have done since that point has been pretty good. So are they never really a sell? That's a hard question to answer because we don't know how the energy will transform over 20 years.
Yeah.
But certainly in the next 5, even 10 years, I could not see myself selling a company like Shell.
No, me neither, unless management really screws up, but there's no evidence or any warning signs on that one. Actually, to the opposite, it makes you want to buy more. So that's the question also, right? I find the share price at around 28 euro. I find it not on the high end, actually. I think it's fairly valued, probably somewhere across the cycle. But I do know if there's a energy glut again or something like that, that we will be able to get this for much cheaper. Yeah. And of course, we cannot predict the future, but I don't think that this time is different. Yeah, to say those four the dangerous word. I don't think so. I think we will see this one time again. And also, it's my largest position in my portfolio. So this dividend hike of 15% is really carrying all the dividend hikes, which were a little bit soft this year. It's the second hike, right? Second time,
Yeah.
15% for them.
Yeah.
And, you know, never sell Shell. I think we are buy and hold and then evaluate investors. Yeah. So we're not blind to these kinds of things. So yeah, I'm just kudos to the company, how it's been navigating everything, and you know, these buybacks as well, and it's just simply amazing. I'm just having one question: do you think this company will ever sustainably break the 30 euro barrier?
Oh, I think it will. I think it will. The issue I have with this company is I love the company so much. I want to buy more, and people listening to us will be asking, why aren't we buying more? But like you said, it's a very cyclical company, and it's going to come to a time where that share price is going to be depreciated for a number of reasons, and to be all negative in the press. And that's the time when people will not want to buy it. So it's kind of hard. People want to buy it when it's at the top, and then it will fall. So I'm really, really hoping that something will happen temporary where it depresses again down to the 15. But honestly, I do see it breaking the 30 euro mark.
But that would be amazing, because the last time it did that, so maybe if you only purely look at share price for Shell, the only time when it was above 30, let's say, was in the .com bubble. It went to an all-time high of 34 euros. Yeah. And then it crashed to like low 19s. Then it went up in 2007, before the great financial recession, to let's say it touched 30. Then it went down again all the way to 17 euro. Then in 2014, it touched 30 euro again. It went down again with the oil glut there in 2016 to 18.5 euro. Then it went back to 30 again. And then with COVID, it dropped all the way to about 10, 11 euro. And now we're touching almost 30 euros again. So over the last 22, 25 years, if you stepped in at around 30 euro, you only had your dividends as return, which is not too bad. Let's say 4%, 5% annualized over those whole decades, but it wouldn't have been a good investment. Yeah, so that's I think also when you look from a total return point of view, it has been dead money for 2 decades. Yeah.
So what I'm hearing, and what I'm choosing to hear, is it's due a drop sometime soon.
Well, if technical analysis was so easy that you just pull a line top bottom, yeah, then maybe, yeah, but I don't believe in
Yeah,
this kind of things like that.
I can honestly see it sustaining above 30 though. If you look at what they're delivering right now, I think if they can continue that for maybe 2-3 more years, easily they'll break that and sustain above it.
It must be when you look at it from a buyback point of view. If
Yeah.
they continue to decrease their share count by 8 to 10%, at a certain moment it needs to push it up, because the numbers per share will just look so much better. I mean, if they continue buyback, maybe God knows in 20 years they will be like having I say it, a free cash flow of 30 euro per share. Who knows? Yeah, you will not pay one times FCF by that time. So
no.
yeah.
Cool.
And then there's also one picture in there, by the way, why I'm convinced that they will be able to continue buying back shares, because they have this like really one nice picture in the presentation about $40 oil and $50 oil, and what they can do with that, and that let's say the dividend is safe or covered, I think, until $40 per share. Now, I think we will not see it for a long time under the $40 per share, like we saw in 2020 as well, for a few weeks, maybe a few months. And with the balance sheet that they've been building up now, they should be able to weather that. It's a total different company balance sheet wise compared to the run into COVID.
Yeah, I agree. Okay, look, everyone knows our thoughts on Shell. It's a company that is close to our hearts. It's definitely worth watching, and let's pray for a dip.
Yes, exactly.
Some dividend hikes then this week. Target, which I think you recently initiated a position on, hiked their dividend by 1.9% to $1.10 per quarter.
This was actually anticipated, a low hike. Also, Live with Dividends, who was a guest on our show, did a poll on Twitter, and also most people, actually 53%, I think, on his poll, believe that there will be less than 5%, and I agree with that. I couldn't see it, but this is where the value investor comes in. That it's even not cheap, the share price, but at least the yield is there, so that's why it was an initiating position. And yeah, I think this company just has to deal with some things like the amount of theft that's happening. It's really impacting their earnings. So I think they need to deal with some of these things. And, it's a consumer staple with 50 years of dividend history. So they will be fine, I think.
Yeah, just on that theft, I was reading on Twitter now. I can't verify the source if it's real or not, but it seemed pretty legit. But they're saying in San Francisco, hotels and all that are handing back the keys to their buildings because the theft, shops are closing down, the theft is getting out of control, and there's no punishment, I suppose, for the perpetrators in doing that. So there's no incentive. All the drawback is on the companies, which is a shame. And if that starts to spread throughout America, I mean, it could have dire consequences.
Well, that's what they call the Wild Wild West.
We keep going. Caterpillar, which is a nice company that we don't speak enough about, hikes the dividend by 8.3% to $1.30 per quarter.
Yeah, what a growth story, right? I believe in 2017 or 18, they only paid 77 cents per share. Yeah, they nearly doubled the dividend in those 5-6 years. The compound annual growth rate is really strong there. I had the opportunity to buy them. I was really like almost triggering it, and I bought something else instead for that money that time. And boy, what do I regret it? There was at the time that they thought like China will compete with their tractors and everything, but who doesn't want a Caterpillar product? I mean, it's like the Coca-Cola of farming together with Deere, or construction, let's say, the Coca-Cola of construction.
COVID was the time, 2020 was the time to buy these guys. They were under $100. They're sitting at 245 now, and they have a decent, the yield is 2.12 now. So you're looking at about 5-6% dividend yield if you had to buy them.
It is a bit of a cyclical company from that point of view, because if construction slows down and government spending slows down all around the world, like infrastructure spending, this impacts their sales. But this company is so well managed.
Realty Income, as expected, announced another monthly dividend increase to 0.2555 per share. This is their 121st common stock monthly dividend increase. 121 monthly increase.
Hallelujah, right? Yeah, we did it on the business breakdown about them, and I'm just amazed with this grower. It's like,
yeah,
amazing.
They just keep on giving back. And then the last dividend hike is Essential Properties Realty Trust. They hiked their dividend by 1.8% to 0.28 cents quarterly per share. Ticker symbol for that is EPRT.
Yeah, and I've been looking into them once, and that's why I added them here to the dividend hike list. I didn't buy them, but I know it's quite some people in the community might have it actually. Interesting stock in general. Just never pulled the trigger because I don't need 20 real estate investment trusts in my portfolio. So
yeah, nice one. So the main topic today, it's quite a nice and easy, relaxing one for us, and it is 4 stocks that we are buying right now. I might start with this one because there's a company I've mentioned quite a few times on the show over the last number of weeks. Again, this is around the time, actually this weekend is the weekend I get paid, so I will have buy orders for these 2 companies that I will talk about. And the first one is VICI Properties, which is a real estate investment trust. They have one of the largest hospitality and entertainment gaming portfolios in the whole wide world. They formed in late 2017 as a spin-off from Caesars Entertainment. And I suppose everybody will know Caesars Entertainment from Las Vegas. Currently, at the moment, they own around 49 gaming facilities, which compromises of around 124 million square foot, which is quite incredible. And that's including casinos, nightclubs, bars, and restaurants. At the moment, Caesars Entertainment generates around 40% of the rental income. So that's pretty much Las Vegas. If you think of the Las Vegas Strip, that's pretty much it. But they're not just in Las Vegas. They are buying outside in Canada. And also, they are buying non-gaming related properties. So they're going into some resorts. So Europeans mightn't be too familiar with some of these resorts, but if you look at the Great Wolf and Hard Rock resorts, they are actually starting to go into them. So they're not only focused on gaming, which is quite interesting, because I was always wondered, where will the growth come from? We know they have to do acquisitions. We know that they own most of Las Vegas at this stage, but where else do they grow? So it's actually good for me to see that they are expanding not only in the gaming industry, but also into other resorts. They have a short history, which, look, it is a concern. We don't know what their dividend history will be, but in terms of the last 5 to 6 years, the growth rate has been really incredible. We're talking double digits. I don't think that will be the case forever. I'm expecting maybe 5 to 6% over the long term. But obviously at the moment, they're still in that acquisition stage, they're still in that young growth stage. The downside of that is they have quadrupled their share count in that short history. So they have to do that to generate the cash. They have to buy more properties. But in doing that, they are growing the revenue, and the funds from operations is growing at a much quicker pace than what they're actually buying them share backs for. So yeah, for me, I think it's a really top quality company. I think it's well managed. The balance sheet is quite strong. I also think it's one of these companies that will not suffer from this work from home mentality. We spoke about that a couple of weeks ago. Yeah. Real estate investment trust that working from home will hamper. I don't think it's the case for these. You can't work in a casino, a hotel, a bar, a restaurant, or even a resort from home. You have to be present there.
Well, you can do online gaming, right? But I assume that this is more about the experience.
Yeah.
To go to Vegas, baby. Yeah.
Everyone can do online gaming, but sitting there in your room on your own at 3 a.m. looking at a screen is not the same as going to Vegas, having all these waiters and waitresses fall all over you, get you drinks. The drinks are free, quote unquote. You're paying for it with your time. But the experience is second to none. But I really think this is a well-managed company. It's a high-growth company. I think there's good potential there. As I said, it's just
maybe about that, the potential, like, because this is where I struggle to see, like, what is kind of the total addressable market for such a company when we think about acquisitions? I mean, how many casinos are there, and how many could they buy before they own the entire Las Vegas? How does that look like?
Yeah, well, they would run out quite soon. I think they own the majority of Las Vegas at this stage. They acquired MGM, which
Hmm.
is a major company back in May of last year, and that took their percentage. I think it's over 50%. So there's not much growth within Las Vegas itself. They are looking outside in Canada, but as I said, it's going into the non-gaming industries as well. So there's plenty of growth
Yeah,
across that. But I think Las Vegas itself is obviously the big driver. But Canada is also a strong gaming industry, and
yeah.
they're starting to acquire companies there as well. Um,
Okay.
but there will become, like, I think it's a fair question. There is a point in time where you think they can't acquire anymore, and then where will that growth come from? But I think for the next 5 to 10 years, I think we're safe from that perspective.
Okay. Good, nice holding. I hear that always on social media. A lot of people own this. I honestly, just because it's gaming, it never attracted me. And that's the funny thing, right? As an investor, I'm always looking for dividend cash flow, but
Yeah,
somehow Vici never attracted me. So it's kind of the joy of missing out that I mentioned last week as well. Like, we know we can't own everything, and so sometimes I also have like, okay, look at it. It doesn't appeal to me, so why bother?
exactly. Yeah, you're right. You can't buy everything, and just because something is shiny and new online doesn't mean you have to jump. But we all know my background in gambling
Yeah.
and all that, so it's like close to my heart.
Well, I think it's a way better way of spending your money by buying casino properties rather than spending it in the casino itself.
Exactly. Hey, I must say that to my wife.
Exactly. Like, hey, a nice pick, and my pick is more like for the people that get in trouble by spending too much time in casinos. So my pick is an insurance company, ASR. I bought some on Thursday again. Why? I think that there are two main reasons that really stand out. First of all, that appeals to me. It's a 7% annual yield at the moment. So they pay €2.70 in shares per share, and they were able to bump their latest dividend quite a lot because of the Aegon merger that they did with their how is it, pension funds and such. So what they also did, and that's the second part that I really like, is they changed their dividend policy in 2022. So in 2021, it was clearly connected to the payout ratio of their earnings, and then they would reserve enough cash on their balance sheet. Let's say based on last year's dividends, they would accumulate again cash there so they could pay it out going forward as well, to at least make sure that on the first earnings blip they wouldn't straight away need to cut the dividend. But in 2022, they think they got more self-confident, and they said like, okay, there will be no direct link anymore to the net operating result, and they really are now for progressive dividend in the low to mid single digit growth per annum, which means like 1 to 5%. But then with the Aegon announcement on the 27th of October, where they want to combine their Dutch pension life and non-life insurance and banking and mortgage or activities, they said, hey, let's increase the dividend then to 270, but we also increased our policy to mid to high single digit annual growth until 2025. So if you take the 270 now and you think about, well, maybe one time a 5% growth, then a 10% growth, maybe another 7% growth, you're talking about a really nice juicy dividend and yield on cost. And 2-3 years from now, that sets a new baseline still for progressive dividend policy. So that's why for me this is really attractive, because my portfolio yield at a certain moment was around 3%, and having some high quality companies, and ASR is for me a high quality company, at least in the insurance industry, right? With such a yield also bumps up a little bit my dividend income at the moment, because I need to reinvest those dividends. Now, before I go into the some of the why I think it's an attractive buy, one thing that I I really liked. I read their social responsibility presentation because everything is ESG nowadays, right? And they were speaking to ESG and how they want to be also like a good taxpayer, right? Like a good corporate citizen. It was really nice to read also their dilemmas they have with ESG, and one that really caught my attention was like, should we invest in the arms industry? They have not been investing in the arms industry since 2007 because guns bad. But now with the war in Ukraine, their perceptives started changing and thinking like, well, wait a second, shouldn't free countries and democratic countries not have the right to defend themselves? So with that, shouldn't we invest in the arms industry? Really interesting, right? So they have an ethical commission. They thought about it. They looked at it like this. Okay, we'll still refrain from directly investing in arms producers, weapon producers. But if the Dutch government, as an example, issues a bond which is purely an existing for raising capital to buy tanks, ammunition, and everything, they will do it. So they don't want to buy, let's say, or invest in arm producers or weapon producers because they don't know where the money will end up. Yeah, maybe it goes to some let's say some bad governments or some I don't know, terrorists that want to do wrong, right? So, but they said like, but wait a second, but we can support investing into countries maybe like Ukraine and such, or the Netherlands, where we know they respect the democratic values, and with that, we at least know that the investments are being made are going into the right direction for weapons, and then we support countries the ability to defend themselves. I really loved it that they put it in there. So this was not like what we sometimes complain about, pure woke and window dressing to the investment community. Look how good we are. But actually, these dilemmas that they really called it out, it was really inspiring to me to see this from a company.
Yeah, I mean, when you think about it, it's so easy to categorize weapons as sin stocks. We talk about sin stocks quite a few times on the show, and
Yeah.
weapons is always one that comes up. But when you actually flip it like they have and said, okay, look what's happening in Ukraine. That could happen to Ireland, it could happen to Netherlands, it could happen to the UK, it could happen to France. Why should we not be able to defend ourselves? And the only way to do that is to invest in arms, the army, and have weapons. So I think it is a really good, not a good dilemma, but I think it is a real dilemma to have. And I like the way they have approached it. So they have said, okay, we're not going to invest in the likes of LMT. They are purely an arms company. They do not care who they sell to once they make revenue. What we will invest in is our government, our defense of our government. And our governments, they have a responsibility to defend our country. They have all our best interests at heart. So we will make an investment in that. And I think that's quite fair. And I think it's really good that they're transparent in this, particularly for those investors that are against investing in arms. I think this is really important for those types of people.
Yeah, but all in the end, let's not forget that ASR is also
Insurance
writing
company.
life insurances, so they still have a benefit of this, let's say. So, but yeah, no, but it was just refreshing to read because I sometimes read these ESG reports and I don't really see this written like that. So kudos to ASR for bringing this up. I really liked it.
Yeah, yeah.
Now, having said that, look, I also always look at the dividend safety, and the dividend just looks safe. The average EPS growth was 6%. I can see them growing going forward, also with the Aegon merger of the pension funds and such. Debt to equity, 56%. So it's really conservatively managed. Credit rating, BBB+. I think they could be a little bit higher, but I don't know why the credit rating doesn't give them more. You see this more of insurers. EPS payout ratio, and you need to really look at earnings per share, is 46%. So they've been growing the dividends with 13% over the last 5 years annualized. So I think the dividend is pretty safe. I don't have any warning flags there. Of course, they could have an issue with a catastrophe or something like that they need to pay out a lot. The balance sheet is conservatively enough for that. Also, the solvency ratio is high enough. So I don't see issues there. It's trading now at 38, 39 euro per share. And we know that the insurance industry in Europe is heavily undervalued. I bought NN Group also the other day to exchange for my 3M shares. And also here, I mean, I don't know, but the simple math to me gives me a fair value of 64 euro while it's trading at 39. I almost don't trust my own numbers when I see this.
I mean, it's undervalued by nearly 70% at that rate. But it's strange. Like most insurance companies, apart from Munich RE, which I believe is still absolutely killing it and flying quite high.
And Chubb as well.
Yeah. But most other insurance companies are feeling the pinch. But that creates opportunities. My issue is that I've Legal and General now. I have CSN. I have NN Group. How many insurance companies do I want? They're all cheap.
So I see like that. I'm still in the accumulation phase, right? So I never owned financials, so for me it's only insurers, and it's just for me like a golden time to buy right now, and I don't think I will regret. And with my dividend allocation strategy, I know how much I need to make to be financially independent. I know how big my position sizes can be. So maybe in these 1-2 years, I buy everything I will ever spend on insurers, and then it will sit there and just generating cash for me. And God knows, maybe pharma will be again heavily undervalued next year, and I will shift my money. And that's how I seen the sectors also going through cycles, right? And that's also nice because that's where also it's not a stock market, but a market of stocks. There's always something like there. Undervalued, and it's clear that the insurance companies are hit by inflation on their bond portfolios. But I'm not worried there with these kinds of stocks like ASR.
Hey, nice pick. I mentioned last week with European companies, I like to buy them closer to their dividend. Buying them now, I think they are in February, are they? If I remember, they're one of the first ones. So I'd always look at them before that date. I don't like to wait 9 to 10 months before I receive my dividends for them. But from a price point of view, and as you said, from your calculations, maybe 60 to 70% undervalued. It probably could be a decent time to buy them.
I think the number is not correct. It's rather like 30-40%. It's inversed. But it's funny that you say that, because I don't care about that at all. I bought NN Group on the ex-dividend date, so I missed out on the dividend when I bought some shares. I just think they're a good buy at that moment in time. And what I look at is my own portfolio tracking sheet, portfolio sheet, because on the dashboard there in the middle is just my projected annual dividend income. And every time I spend money, I buy income. And when I need to live on the income, let's say 5-6 years from now, I really don't care whether I bought them today or in 7 months from now. Maybe not anymore at 38 euro, but then at 43 euro. Then I will feel like the idiot. So I have a bit of a different approach to that.
No, makes sense. Okay. I like that pick. I have NN Group. I don't have ASR, but it's a really nice pick. The second one from me is another one that I touched on last week, which was an Irish company called CRH. And again, I'm going to put in a market order for these on Monday. Just to give a little bit of a background on them, I mentioned they were an Irish company. They transitioned a little bit more into the UK to expand into Europe. And now they are transitioning again to list in the United States, which I think makes complete sense. Most of their business is actually done in the US as well. And for a lot of people, a lot of investors, they actually believe this is going to be a real catalyst in terms of price. And I'll get to that in a moment. But just in case you don't know what the company does, they are pretty much an essential partner for road and critical utility infrastructure. They also build commercial buildings, and they have this outdoor living solutions. What's quite nice about each of these is they all rely on each other. They split it into two segments: the material solutions and the building solutions. The material solutions is basically all the concrete, aggregates, and all the materials you need to build roads and infrastructure. That generates 72% of their sales. The remaining less than 20% comes from the building solutions, where they build buildings, hospitals, all this sort of thing. But to build that, they need the materials from the material solutions. So it's really nicely integrated in that side. And then when they have the buildings built, they have this other sub-segment called outdoor living solutions. So they come in and they do the garden, they make it look nice, they do all that sort of thing. So they all seem to lead into each other. In terms of their position, they're number one in Europe. And I think they're at top two within the United States. And as I said, the United States is their largest segment by a mile. Looking at their peers over there, so you've got two companies that rival them. You've got Vulcan Materials, and you've got Martin Marietta Materials, ticker symbol LMM. When you compare the price of these, just in terms of simple PE ratio and also price to free cash flow, you look at CRH, their PE ratio trailing 12 months is around 13 to 14. The other two are 26 and 38. So there's a huge gap already there in PE ratio, and it's the same story on price to free cash flow. So the price to free cash flow for CRH is 8.9, and you're looking at 20 and 22 for the other two companies. So what the thesis is out there is that a lot of hedge funds, they know that this change is happening from listing in the UK and Europe over to the United States. So they're not buying them, they're not selling them, they're not doing anything with this company. They're waiting until that change happens, and then they can, because I think it's a nightmare for them with that, you know, because if you have like these Euro stocks and all this trying to change, it's no longer going to be a European stock. So there's great potential in terms of valuation to catch up to their peers, and I believe they will. I mean, once they become a United States company, they'll be accessible to more of our US peers, you know, that they can't invest so easily in European companies, and it's going to open up a whole new market for them. I really think there's good price appreciation, but then you look at their dividend history. The dividend history is actually quite good as well. Their annualized growth rate over the last 5 years has been 11%. The yield is a little bit on the low side. If you buy the ADR, it's 2.23, but if you buy it on the London Stock Exchange, it's 3%, which is decent.
So you're really also betting on capital appreciation here via multiple expansion.
Yeah, there's both. So they do have a decent dividend history, but I think it's the capital appreciation I think is really attracting me to this as well. So the total return of this company could play out over the next 5 years quite nicely. And when you think about it, everybody needs their materials. I mean, you're always building roads, you're always building hospitals. Like it's one of those companies. Yes, it's quite cyclical. You mentioned the construction segment earlier when you're talking about one of the other companies, and they are obviously heavily involved in that. And the United States might be going through a little bit of a dip in a cycle in construction at the moment, but they are well managed. Their debt levels are quite manageable. I think it's 5.1 billion at the moment. Their free cash flow is in and around 2.4 billion. So
they could pay debt off in 2 years if they would withhold the dividends.
Exactly, yeah. So I think that they're really safe. They're really well managed. And even if there is a period of a low cycle, I think that they're involved in so much in Europe and America. I think it's quite a nice company.
For me, because I studied it as part of also the dividend UK stocks on my blog, for me, it's a high quality company. If you look at that kind of industry, for me, the question is more like, do you want to be invested in such kind of companies at all, knowing their cyclicality? But if you want one, then this is really one of the highest quality there.
Yeah. And the question is, where are they in that cycle? And to me, compared to their peers, they're probably a little bit behind our peers in terms of share price. So I think they have a lot more upside than some of their peers.
Nice pick. I own now some DCC, right? So I'm still thinking sometimes about CRH, but I don't think it really fits in my portfolio. I've got also Rio Tinto and I said BHP, although they are in different industries. For me, they feel a bit the same when it comes to cyclicality here. One, of course, the other two are really materials pure plays.
Yeah.
So who knows? Maybe I'll change my mind one day.
Yeah, I mean, if you were to ask me to pick between these and Rio Tinto, I would probably stick with Rio Tinto based on the reward in terms of dividends. You get a higher dividend percentage with Rio Tinto, so you're getting a higher percentage for your risk. in
You
terms of
don't get the same stability in dividends like CRH because they have like I think few decades of dividend growth now, right? So
26 years, I think.
yeah, look at that. So the stability is much better. But I've got like only BHP and Rio Tinto where I really bought them thinking about dividend income, but not about stable dividend income. So I expect them to cut dividends. And as they did, if you take the bonus dividends from Rio Tinto into consideration, right? So yeah, nice pick, and it's nice to see also you have a bit of a European company in there because lately you've been mentioning a lot American ones.
Yeah,
Don't know if you noticed. So it's good that you're buying some European stock.
nice, nice. I'll work on that. I'm also buying some Enegas as well, but in small amounts.
Yeah, yeah, exactly. So hey, look, my stock then is that I'm buying now. I didn't buy it for quite some time actually because last year was the last time. I'm buying some more HP Inc. So our printer producer, and you would wonder like, EDGI, are you buying, a printer supply company? Yeah, right. I am. I mean, if you also think about printing, but also just the HP laptops and everything. So first of all, let's discuss the elephant in the room. There was a large free cash flow impact in the first 2 quarters, and specifically the first quarter, I believe, because of disappointing laptop sales, right? And for me, it was not really a surprise because the cash flow we saw like 2 years ago there, like 4 or 5 billion, was insane. That we saw with HPN because all those sales were being brought forward because of those those COVID paychecks that America's massively got. So of course, that had to be compensated for, and you see that now we're now going through that cycle, and also the semis are feeling that. We saw Intel, we saw also Microsoft with less sales. So these companies are feeling that. But at a certain moment, again, those assets need to be refreshed again by consumers. I think there will be still a little bit of a setback going forward because we see everywhere the layoffs happening in the corporate world. We see them with Facebook, Google. So all of those companies that are laying off people right now globally, they don't need to. They have, let's say, notebooks left. They can still resupply within their I said workforce. So I do think it will be still a little bit of a winter before the spring starts there, and I can still see this like for another 1.5 year going forward. But hey, at the moment, the 3.4 dividend yield at 31 euro, a PE of current price to earnings of 11.5, but it's a bit convoluted, I would say, but a payout ratio of 46%. Interesting fact though, with the latest 13F, Warren Buffett and Berkshire Hathaway, they have 3.5 billion invested in this company, which is 11.5% of the total market cap of HPQ at the moment. Very interesting that Berkshire Hathaway sees also the cash potential here. They did pause their buybacks because one of the return propositions to shareholders was, reinvesting this additional cash flow into into share repurchases. So they paused that. I think that's good. Although you would have want them to have maybe a bit of a better balance sheet like that, and then be massively buying right now there. Although the shares also not yet that cheap in return. But look, this company gets still 46% of their revenue from personal systems commercial division. So we're talking really here about the HP notebooks that 23% of printing supplies, 9% of printing commercial, and 5% printing consumer. So there's still a large part of that is also in the printing business. And it's interesting because, I mean, I don't know about you, but I'm still printing documents at home. You need to print sometimes forms for school. So I still need this printer. I still need supplies. I can't still throw away my printer in this world where we shifted so much more to digital. So there's still a business for this. It's of course not compared to the consumption maybe as of 10, 15 years ago when everything was still paper. But still they're able to earn money from this. And I think that when you look at the amount of printing we're doing today, I think the digitalization, or let's say the removal of the printer, will go slower now compared to what we have seen the last 10 years. That's my personal feeling. I think we're already at such a low level, and if they're already deriving income from that, yeah, I still see my printer needed for the next 5-6 years. But having said that, they get 42% from America, 40% from Europe, and 24% from Asia. So it's well balanced when we look at the revenue sources. And yeah, I think it's a pretty well managed company. I really like their CEO. If you hear him talking about the business, again, it shows you that they have really, really good stewardship. And I really recommend one time to listen to their earnings calls. The CEO is really, really on top of it, more than laser focused, I would say. Now, if you then think about their outlook, they expect for the next quarter like a 60-70 cents per share in earnings, and they expect still at the moment a free cash flow per share, free cash flow guidance of 3.5 billion. But if you look at the first 6 months, you wouldn't expect that, right? Because they have like a 600 million, free cash flow so far. So they expect still a lot of free cash flow in the second half of their how do you call that again? Their earnings calendar, let's say, because I think their fiscal year end is in October this year. So let's see if they are able to achieve that. Having said that, I think their dividend is pretty safe. They have negative debt to equity because they have negative equity due to share repurchases, but they can easily pay off the interest. They have an interest coverage of around 5. The payout ratio based on the forward earnings, if we take this into account, is around 31%, and if we look at free cash flow, it's 46%. So I feel very comfortable with that. They have good, dividend growth track record so far. So yeah, I consider the dividend safe, no issue there. And if I look at their valuation, I think it is not so far undervalued, about 20%. At the current share price of 31 euro, I believe their fair value is around 37 euro, taking 3 billion in free cash flow as a baseline, at a multiple of 13 and growth of 5% and then 3% thereafter. So I think it's still a good cash machine, and I can see them reinvesting, those additional free cash flow again once sales recover a little bit in the personal computing space.
Yeah, I mean, I sold this company. I mentioned that a couple of months ago. I sold that. I didn't really like the deteriorating balance sheet. You mentioned it mainly due to their share repurchases, and they were so cheap. I think they were around $25 to $27. It was a good time to buy them. I wish that their balance sheet was in a better position to capitalize on that at the time. Even though they're trying, they did so at the expense of their balance sheet. And then we've got this outlook on personal computing and printing. It's quite bleak for the next year to 2 years. And then for me, that means their balance sheet is going to get worse and worse. How they navigate through this is going to be quite important.
Well, I would challenge that actually, because they've paused their buybacks and actually they've been paying down debt. So if you look at those numbers, they are actually making sure their balance sheet continues to be the same as it is and actually improve again. So I think their balance sheet is not really deteriorating over the last half year because they are exactly what the CEO has been doing. They put their balance sheet in this position via share repurchases because they feel comfortable with this, and they focus on shareholder return, and they thought their shares are undervalued. So I think they just don't want to deleverage their balance sheet going forward. That's why they pause their share repurchases and pay off a little bit of debt with the remaining cash they have after paying the dividends. So I think it's actually very conservative management, I must say.
Yeah, we'll see. But I mean, we're looking at a negative equity here that has doubled in the last 12 months. So you're saying over the last 6 months that they've passed on their buybacks.
Well, it's not the buybacks. Yeah, exactly.
It's still not in the healthiest of shape. The balance sheet. It's not one of the best balance sheets you see.
It's not a AAA balance sheet.
Yeah,
okay,
yeah.
I get you that. It's more like similar when you look at this, similar to Starbucks, I would say.
Okay.
The same, and for the same reasons, like lots of buybacks that impact it. And it is like that when you have a negative shareholder equity, and the company would need to be split today, yeah, or their assets would need to be liquidated, yeah, then it mostly goes to the banks, right? So that's the awkward time we live in with all these share buybacks and the impact that it does to a balance sheet. And I think sometimes we do get fooled by that as well. So in the end, when it really comes down to it, most of it is owned by the banks at the moment because, yeah, they used, let's say, yeah, they just kept on repurchasing shares, which negatively impact their equity. So
Yeah. Yeah. Yeah, look, it's an interesting one. They do generate a lot of cash, but as we said, it is quite a difficult period, and I don't see that changing. So I don't know where that growth will come from in the short term, 2 to 3 years. We don't know what it'll be like in 5 years. So yeah, interesting.
good. So I think to our listeners, they heard now 4 stocks we are buying. I'm also, of course, interested to what the community is buying right now because I always find some inspiration in there. If I look at ASR, I found it because our community members were talking about it, right? And did my own analysis then, and now I have a strong conviction around that. So please let us know what you've been buying. Actually, I'm quite interested in that. And by the way, did you see the poll after our last show? I put up the poll on Facebook about what people's foundation stocks are, and damn, it's amazing. You know, I was really thinking we should build an ETF out of this. It really looks good. So I mean, of course, Johnson Johnson is one of the most popular, but also Realty Income. Really, really interesting what our community thinks are the top 5 stocks. I think we got more than 1,000 votes on this. So this means like if everyone did like 5 votes, more than 200 people voting on this. It's really, really nice to see.
Cool. I might check that out and set up a trading 212 Pi just for that.
but you need to put money into it then, right?
Yeah,
Will you do it then regularly or just a one-off?
I know. I'll put like a recurring €100 a month into it or something like that, and just let it build and see
Oh,
where
cool.
it see where it ends.
Let us know. Shares the pie and also like what the average yield would be of this pie and how it looks like. And and I'm curious whether you want to do it equally weight or whether you want to use the percentages out of the poll.
Oh, that's a good one. Yes. I'll use the percentages out of the poll, but yes, I'll follow.
Okay.
I'll follow up with that.
Yeah, and share it with me. I'm really curious to see how Trading 212 shows the return and such and how it looks like.
Cool. Okay, we have a good few questions to get through again, so we'll start with Divis Sleuth. Hi guys, I noticed you never mention any Canadian companies. Is there any reason why?
No, well, yes, there is a reason why. It's because I don't know them. Yeah, it's simple like that. They are not so much discussed. You need to follow Canadian bloggers there. But for instance, I don't have any feeling for them because also those Canadian companies really are not really present in Europe. We have Couche-Tard, I believe, the equivalent of AOL. We know them from, I think, the Circle K gas stations.
Yeah,
that's probably about it. Yeah.
Yeah, I mean, look, in our defense, we have had a couple of Canadian bloggers, influencers on our show.
Mike.
Yeah. So we do try to give that a bit of perspective on that. My problem is some of the companies, most of them are banks. I don't want to invest in banks. And then the others, the yield is probably too low. So you mentioned Couche-Tard. There's some Canadian railway companies as well. And generally when I'm researching, it's usually European or American. It's not by design, but I don't look at Chinese stocks or Brazilian stocks or Australian stocks either. But we do know that there is a market and a niche there, and we do try and bring in some guests to give that perspective. So if you haven't listened, I would recommend checking out both I wouldn't say interview, but the discussion with both Mike, the dividend guy, and also from Bob as well. They're both actually really, really good.
And I would also just recommend then to follow Mike's podcast. He has his own podcast, right? And he discusses a lot of Canadian stocks there. So I would definitely go to follow us and listen to his podcast as well.
Yeah. Daz Mikey, he's asked us a hypothetical question here. Would you rather invest in a company that is 30% below intrinsic value with a 5% dividend yield and a dividend safety score of 60, or B, a 30% overvalued stock with a 2.75% dividend yield and a safety score of 80?
Yeah, that's a tricky one. That's really a tricky one. But if I look at my own behavior so far, usually I end up doing both.
Yeah, pretty much the same. I'd probably just maybe side with A, but like you, I'll probably end up with both.
Yeah, if someone put a gun on my head, really on a gun on my head, and I would need to hold it for 20 years, I would probably go for the 2.75% yield, because then it would be really about never sell. And the safety score assumes also here, therefore, like proper business behind it, right? Business quality. So I expect it not only to look at payout ratio, but I expect it to really look at the balance sheet, their growth prospects. Do they have a catalyst and such? If it's that, I will probably go for the 2.75% yield, because I think we can expect dividend growth, let's say, more of that going forward here.
Yeah. No, to be fair, Mike, you did say they both grow their dividend at the same pace, but which we
Yeah,
know
but you
might
didn't say for
for
how
how
long.
long? Yeah, for how long?
Yeah.
I still think I would rather A a little bit, because I think the risk to reward matches up just a little bit. I mean, you're getting a 30% below its value, a 5% stamp yield, and we're going to assume over the next 3 years the dividend growth will be at the same rate, at the same pace.
Yeah.
So I think I would maybe edge on the side of A, but B is probably your swan, your sleep well at night stock.
Yeah, I would go probably today at least for B, but ask me tomorrow again and I might answer A. It really is influenced by the day sometimes. So. But what I do know is I need to focus more on high quality. I think I'm doing that lately. Even though I'm buying high yield stocks like ASR, I still feel that those are good quality stocks. So
Adrian has asked us, do you think T Rowe Price, ticker symbol TROW, has raised dividends much faster than earnings in the last 5 to 6 years? Is this increasing payout ratio sustainable?
no, it wasn't, and I took that also into consideration when assessing T Rowe price, and that's why I've not been buying them at the $200 share price, but now at a $110 share price. Yeah, so it's really about the value for money that you get here, Adrian. And what I like just is about their spotless balance sheet, and that they are prepared for these kinds of cycles. It's clearly now in a lower cycle. That's why the dividend hike was lower. And yeah, I feel pretty comfortable with this. I don't expect them to grow at the same rate going forward, but depending on how earnings will be in the future, they might hike a little bit more again. They're really well in managing through the cycles, and that's how I look at this.
Tim has asked us, is there a place to track where cyclicals are at their peak by sector? For example, companies like Shell or Rio Tinto.
No, because Tim, this is actually a funny question, because it suggests that we know when they are at their peak in the sector, right? And I think the one that can define such an algorithm, saying like, guys, now whistle the bell because we're now at the peak, that person will be a genius. Yeah. So and lots of money to be made. So I think that I'm sorry, Tim. Here, I don't mean anything bad intent here, but even your question sounds a bit flawed. But I think generally, if you look at it right, there you can set this up yourself. So typically, when earning multiple on energy stocks are really low, and what means low for me, let's say 7 PE, 6 PE, 5 PE, that's usually an indication that the market finds it to be at the top of a cycle, because seemingly investors are not willing to pay more for their earnings, which is really awkward. So it also means that investors expect their earnings to decline in the future. Otherwise, no investor would pay 5 to 6. They want to pay 12 or 13 multiple for their earnings. So I think you need to look at a little bit like that. That typically those companies, they have low multiples at the peak and high multiples at the bottom.
Yeah, and another quick way to check is maybe use sentiment. You can use the sentiment of other investors online. We know when the sentiment of the likes of Shell and Rio Tinto are really bad, when everybody's giving them bad press. There's nothing but bad news coming out, and they don't expect to see anything in the next 2 to 3 years. You know, they're pretty much going to be quite low. And it's the opposite when they're high, because it's sentiment is always nearly delayed. So they've had a good run up like Shell has had, and then all of a sudden everybody wants to buy them, everybody's talking about them, they're in the news. So sentiment is a good gauge of where they are in the cycle. But if you want a better hard and fast rule, European DJI's method of judging the multiples is definitely a good way to do it as well. Yoris has asked us, can you switch from stocks to get more dividends? For example, I have €1,000 invested in Coca-Cola, ticker symbol KO, with an ex-dividend date of the 1st of September. After the payout in the middle of September, he sells the stock and buys another stock with the ex-dividend date of the 1st of October to collect dividends. So he double the payout in 2 months. Is this possible?
Well, this is dividend harvesting strategy that you've been doing quite a lot. And I've got one experience with it with BASF. I bought the stock, sold after the dividend date, but I didn't do it like 1 day before, 1 day after. I did like few weeks before and few weeks after. And the stock share price plunged during that time last year. So the capital loss was just too huge for me. So, but what is your experience about dividend harvesting?
Yeah, I mean, it's definitely easier in a raging bull market when no matter what way the wind blows, the share price is going to go up. So typically on ex-dividend date, you're going to see a reduction in share price. And I think the best case I could give you is to look at ticker symbol ZIM. ZIM. It was a popular one for this, because they paid out such a high dividend, but just watch what happens on their dividend. Because some companies, you know, they're paying out cents and you don't notice it as much. They were paying out nearly 25, 30 euros. So you can really see that drop in the share price. So in all cases, it will drop. In some cases, it can rise before the end of the day, or before, as you said, at the end of the week. So it's definitely an easier strategy in a bull market, but it is not as simple as you think. I've made and lost money on both of this, and European DJI said that is something I do. I haven't done it this year. I remember I made that commitment to focus on dividend growth investing this year, which I am sticking to no matter what. It does seem like an easy way to make money. There's people that do it. There's certain companies that probably work better than others, but as a general rule, you will lose money doing it this way.
Yeah, that's my only experience with BASF as well. But I think the question underlying here is also like, how can I get more yield out of my €1,000? Yeah, and here I would say, like, if I have to choose between dividend harvesting and option selling, I would go for option selling, because then you can say, like, okay, for this €1,000, I don't know, €1,000 maybe not sometimes enough, because you would need to talk about an option of €10 and a share price of €10, but let's make it €3,000 and go for a share price with 30 somewhere. So then you could say, like, okay, I sell put option on, I don't know, $28 for HPQ, and I know I want to own it at that price. Yeah. Or I sell a put option, which I actually did on €28 for Ahold Delhaize, because when it touches €28, I don't mind owning 100 shares. I would actually love to own some shares then. So, and then at least you get some more yield on this, but then you're really starting to do option trading. And we also have mixed experiences with that. I would generally also not recommend doing it if you are not comfortable with losing money and the risk of losing money with option trading, even with a relatively option strategy that's considered conservative under option traders, let's say. I would stay away from it if you're not willing to lose all of the money there.
Yeah, I mean, we talk about cyclicals there, and you could consider new investors, and I'm going to put myself in here as cyclical, because you start off investing and you reach dividend growth investing or dividend investing. It doesn't have to be dividend growth, and you're getting this yield, but maybe it's 3% yield, and your brain is thinking, okay, what if I can make more yield? I want more money faster. I want to retire faster. And you think of ways of doing that. So dividend capture is one way, options is the other way. And in theory, and I'm guilty of this myself, you can make it seem simpler than what it is. And every strategy, honestly, in a raging bull market, every strategy is easier
Yeah.
because the stock price is going up faster than what
Yeah.
than what fundamentals is telling you. It's only since COVID and since we've had this kind of ranging market or even a slight down market that you need to be a little bit more technical. You have to understand the mechanics. You have to understand the Greeks of
Yeah.
options. You have to have the capital aside, because if you're doing it naked, which means you don't have enough money to cover your puts or calls,
Oh, yeah.
you're going to lose a lot of money.
Yeah.
If you're doing it cash secured, that's cash that could be making money in dividend stocks, but instead you could be stuck with companies like I have,
Yeah.
like CCL, which I've actually just sold yesterday because
Yeah.
it has recovered, but solo wish. So it's like a natural evolution. You're trying to extract as much yield out of either greed or trying to accelerate the process.
Yeah.
I've taken a step back, trust the process, stick to dividend growth investing, and enjoy your life. Do other things, read a book or do something else.
Yeah, yeah, but it's hard, right? Because I think for specifically beginning investors, they then see on social media, let's say on Twitter, there are some accounts with more than 100,000 followers that are saying like, oh, I fuel my income and I get retired quicker by this call option, selling call option strategy. So I buy 100 shares in this and I continue to sell calls on this one. And you see their numbers and you think like, damn, I'm crazy not doing that, right? But I really, like you say, please, guys, practice the joy of missing out again. Yeah, on this one. I'm doing it a little bit. I'm 7 years down the road. I feel comfortable with owning Ahold, at $28,
Yeah,
at 28 euros. So for me, to have a little bit of option income there is fine. I'm not doing what you did on shares that I don't want to own.
yeah,
I got some shares in the past assigned, and those were all for companies that I don't mind owning. I did the same with the dividend capture strategy. I did it for BASF, and it was fine. Yeah, because I wanted to own some shares in BASF, and I kept them. So that's, I think, really the main distinction. But Joris, ask yourself really, like to what Derek says. I would we have a hoodie. Stick to dividends, boys and girls. And I think this is kind of,
yeah,
really ask yourselves, like, is it really worth it?
yeah. I think if listeners listen to our show long enough, they'll probably see my journey going through that. And
Yeah,
honestly, as I said, I have two companies that have lost over 90% of their values because of this. Now it's not huge money, luckily, but it
yeah.
could have been. So just be careful. Simon has asked us, if your wife or significant other absolutely insisted on managing your portfolio from now on, what three simple instructions would you give them?
I've been thinking a lot about this question when I saw it coming in, and I would say, like, every time ask me whether I would invest in the same. So I would turn it around again. Yeah. I would say always ask my opinion and please consider it.
Now,
And
do,
yeah,
do you do you ask your wife her opinion now?
yes, I do often, because that's the fun fact, right? I mean, I'm in total control investing our money in dividend growth portfolio, but I truly believe if your spouse is not on board with you of spending half your family income on dividend growth stocks, you'll run into issues sooner than later. And I experienced this one. I did my annual report. I let my wife read it, like, back in 2021, and she said, "Why the hell do you have British American tobacco in there? I don't want to see the sell." It was a really great reminder to always discuss your investments and why you're buying shares. So, first of all, Simon, I would tell her to seek my opinion, but still, she owns the investment decision, right? That's the here.
Yeah,
Um, Knowing my wife's passion for finance at the moment, I would probably recommend investing it in ETFs, even if it would be a poor performing ETF, because she doesn't have the same knowledge as I have today. So I would say, while you're spending half of our money, put in the ETFs, but buy some books and start reading, and then consider individual stocks again, because as a European investor, with an ETF, you will probably not outperform the markets because you will pay high expense ratios like 0.5 or something like that on a simple ETF tracking an index, yeah, or 0.3. So that with that you're always underperforming. So I think, and stock picking is just, I think, better, at least for me and for our family kind of risk appetite. So I would ask my wife to study, and then maybe after a year switch from ETFs to individual stock picking. And honestly, I think she will do better than me in stock picking at times, because I think she's more streetwise than I am with investments. I'm too analytical, which sometimes works against me.
Yeah. I I would ask my wife to read all the books I've got and to maybe
Mm.
buy some others that would interest her so that she understands what she's doing, whether it's ETFs, whether it's picking single stocks, it doesn't matter to me. Once she has an understanding of that and not just doing what a lot of people do and going onto Reddit, onto Twitter, and just picking companies based on what their friends and what other people
Yeah.
say. I would want her to make her own rational decisions.
Yes, exactly. That's so important. Yeah.
The second thing I would probably tell her to do is, as knowing my wife, she's very, very good at managing the money, and she does manage most of the bills and all that in the house. But what she can do sometimes is move something temporarily out of one account into the others until money matches up, and she does all that. I would say from an investment point of view, when money goes in, it does not come back out. You leave it in there.
Exactly.
Compound interest can only work
Ooh.
when you leave the money in.
I will steal that one from you. I will do that. I will say that as well.
Yeah. And then the third one, I would probably ask her to only invest in companies or ETFs in what she knows. So we've got lots of different companies out there. Like if she was to invest in someone like HPQ, she has no clue. She doesn't even like technology. She'll tell you that
Yeah.
she's a technophobe. She'd have no interest. So her reading about that company would be pointless. But if she was reading about L'Oreal, for example, or LVMH, or many other different types of companies, she would understand that business probably better than what I would, and would be able to make a rational decision, which goes back to point one on those. So that would be my
Nice
ask.
one. Nice one.
Billy has asked us, when I started this journey, I used to think that mega companies with thousands of products means they had one hell of a moat. Given what we've seen with 3M recently, do you guys think that this is a generally safe assumption?
No, I don't think so. But there are two things that come to my mind, because a moat is more like a protection layer to your business towards competition. Yeah. So how easy is it, for instance, to copy your products, your business model? How easy is to compete on price? That's for me what a moat is, and that's why monopolies or oligopolies, I think that's how you pronounce it, are kind of the best forms of business when we talk about moats. Yeah, like if you think about the telecom industry and such, the moat there is that it takes so much capex that's not easy to enter this industry, right? And only T-Mobile in the US has been able to really threaten AT&T and Verizon there. So that's for me what moat means. But then I think and 3M has this mode, in my opinion, because Post-it, if you think of the brown, and it's of course a really minor of their share, but their mode is really high quality products and their brand that they build up around it. Yeah. So I don't see really the mode here. I think what is underestimated often, or what it's usually, I said, blended in with, is growth prospects. And then you talk about the total addressable market. What is really the total addressable market for a large cap like 3M? I think their growth is probably around inflation and just a little bit more, because of the innovation that they can bring in. But then the risk that we have seen that effectuated with the hindsight we have today, that a company like this just carries so much risks by how society evolves and how we reflect on on the products and I said the chemicals they use. So I think there's a risk probably that a company is exposed to that we might underestimate with large caps.
Yeah. Okay. I
Probably
kind
not answer the question, but I don't believe it's good to think like, it's a blue chip company, it will do well. We have seen that IBM has been that money. Yeah. Why? Because there's not a catalyst. Yeah. 3M, there's not a strong catalyst at the moment. But even you could argue it would be still a sound investment because they will be able to beat inflation just all the time a little bit. The risk that has exposed, I think not many people saw that coming, including myself.
Yeah, thousands of products for me doesn't necessarily mean they have a moat. There's probably 10, 20, 30 high quality products within those thousands that give
it's like
them,
our portfolios.
that give them that moat. Mike has asked us, do you guys keep a bit of cash on the side to be able to take advantage of a market crash like we had in 2020?
So I did that early on in my investing career. I called it the war chest. I still have some money on the side more because I'm, how I said, just by maybe not being so efficient in managing my money when it comes to, a bonus that I get. I don't spend my bonus all at once. So, but it's not there, Mike, for when a crisis would happen. But more just for dollar cost averaging and out over the year, because I don't feel really comfortable spending my whole bonus all at once in a single month. That's more the reason. But no, I mean, in the 8 years of investing, there were two crises. It was the oil crisis in 2016 and in 2020. I've been waiting longer for the crisis than I could have spent the money better. Yeah, that's what Peter Lynch, I think, always says. Also, like, there's been more money made, more money lost waiting for a crisis than more money made in the crisis itself, something like that.
Yeah, no, I'm fully invested as well, just to mention. Mike has asked the second question around ticker symbol CCOI, Cognet Communication Holdings. He says it has a good dividend and good dividend growth. How safe do you think their dividend is? I haven't ran it through our screener, which I must do. But what I can tell you is that I write for them on Short Dividend, and we have a dividend risk score of F. Now this starts from A all the way down to F. So they have the lowest dividend safety for us. To put that into perspective, Johnson & Johnson has an A. These guys have an F. So it would mean that there is some risk attained to that dividend. As an interesting fact, VICI also has a dividend risk score of F, given how short their dividend history is as well.
Okay, interesting.
Marek has asked us, what was the biggest mistake in your investment history about forecasting stock valuation? It can be positive or negative. And my one was Tangor. Remember good old Tangor when I bought them as a real estate investment trust? I bought them at about $20. I bought them, they cut their dividend, not cut their dividend, actually stopped paying their dividend. They went down to 5. I was there, okay, this company is dead. They'll never recover in share price. I sold them at 5 and they shot back up to 23. That's singly so I bought high, sold low. That's pretty much
classical example.
Classic, yeah.
So for me, it was Tupperware. Tupperware was really attractively valued, I thought at the time. I underestimated how dead Tupperware was as a brand. I still looked at it from, the Tupperware parties that I saw my parents doing. And then I heard the CEO talking about, the Asia, how it's empowering women to become entrepreneurs in Indonesia. And they're all doing these Tupperware parties. I thought like, well, that's a great growth market. Maybe it's a bit, over the top in America and Germany, where their biggest sales come from, but APAC will make it up. And I fell in love with the CEO. I really believed him. And oh boy, what was it all wrong? So bad. And I sold it again at a loss. And it was a really big learning to not fall in love with a CEO. Although I fell in love with Satya Nadella from Microsoft. So I don't know, Marek. I have a big feeling I will continue making some of these mistakes, even though I know the roots of the causes of my mistakes.
Sean has asked us, how can a person tell the difference between a dip and a yield trap? And I think very simple way is fundamentals. Is the share price going down because of fundamentals? They've deteriorating, or there's something wrong, or is it just going down because there's something in the news, quite a little bit negative, but the fundamentals are the same, or if not better? I think that's probably the best way for me.
Yeah, I think so as well. Sometimes you just figure it out only a year afterwards.
Yeah,
Let's be real as well.
yeah,
Sometimes you don't know whether you're buying a dip or whether it's a falling knife. You might feel like the that you all have it right, that you think like there's a high quality business and the catalyst is good, and then the market is telling you something totally different. It's just a humbling experience, and sometimes it will be a dip, and another time it will be a yield trap. Yeah.
Michael has asked us, what do you guys say about the new huge Intel investment in their new factory in Poland?
I love it. Living in Poland, I think it's good, specifically in the regions sometimes, because everything is here, and like in Warsaw and Krakow and such as big IT. But it's good also for the rest of Poland to get some proper investments there. I do hope that it will come with good opportunities for the region and such. I think I'm really positive about this, and hopefully also it will create some people to educate themselves in chip industry, and that it therefore maybe becomes more interesting for other companies as well to put some manufacturing plants here. The main thing what I would like Poland to do is to support a little bit more like entrepreneurial companies to grow in Poland. If you look at the stock exchange in Poland, it's quite poor what you see on there, and there have been some really good investments like this what is it, this post in Paczkomat and such, which is now listed in Amsterdam. So there's really entrepreneurial spirit here, but I would like the government to support it a bit better, because this energy needs to be unleashed in a proper way. And if you look at the stock exchange, what really there, it's like old companies. So these startups, they will need to really scale and flourish so that over the next 10 years, this whole Warsaw Stock Exchange looks differently. And also there needs to be a little bit more of a protectionism here, that not every time when a company is doing pretty well, early on it gets acquired here. And yeah, so I'm a bit of in favor of a little bit of protectionism here. It's of course anti-capitalistic, but yeah, that's my thinking.
Okay. Mikhail has also asked if you will update your presentation about oil majors in the future.
Yeah, I should do this. It's always around this time that I do it, so I will have a look at it.
Okay. And we got one from Merodrad, and he's asked us, have you ever looked at ticker symbol MFC? It's a Canadian insurance company.
So I believe he's talking here about Manulife. I've looked into them in the past. I just remember that I wasn't really convinced with them. I think they have a good business, but then when I looked at their history, I didn't find it stable enough and not so convincing like the others that I owned at the time, and the opportunities are there. So Meredith, I can't give you really a detailed explanation anymore. But yes, I've been looking at it in the past and just didn't convince me enough at the time. I believe the yield is now 4 point something %, if I'm correct. So, but I can't say anything meaningful more than that, Meredith.
Okay. And then it's not really a question, but we have a bit of a comment from Matthias, and he's listening to some of our old episodes bit by bit, which is great. But what he finds interesting is, in hindsight, how some of our thoughts have changed. So, for example, you were very pro 3M. Obviously, nobody could see this litigation coming, but he thinks it would be interesting to analyze the thinking of the old episodes with the reality of today.
I actually think it's funny because of the question, but we just touched upon that today. I really didn't see it coming, and that happens sometimes. That's investing. I neither didn't see coming that Microsoft would have such a run-up, or that Apple would have such a run-up, which I bought as well. I thought like they would do well, but and Apple, what they have been doing with the earpods and everything, and how they generate these new business lines, it was beyond my imagination. So it has an upside and it's a downside, right? Sometimes, and yeah, it makes investing fun, I would say.
Yeah, exactly. It can't always be in a straight line.
Yeah, and you can't borrow conviction. Yeah, you can't borrow conviction. So that's what it's also all about.
Awesome. Thanks a million to the community again for all the questions. We do really love answering all of them. There's some really good ones there. And hopefully we'll see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.